Midland States Bank, Thai event, trust, investments, expertise here for January. For those of you maybe who participated in some of our previous calls, you'll note that we had previously done this on a quarterly basis, and we've switched it up a little bit. Hopefully all of you are enjoying our audiograms that we're putting out on a monthly basis, as well as our quarterly newsletter that we still put out. And so we're using a little bit more frequent contact to kind of substitute for some of our quarterly events. But we did want to pull everyone together. Obviously, a lot going on in the world right now. And first of all and foremost, we hope all of you have stayed safe and stayed healthy in 2020 and as we roll into 2021. And we felt the timing was right with the election and everything that still continues to go on with the pandemic to take a look at some of the questions that we're hearing from our clients out in the field, from some of you in regards to the economy and the markets. And so that's what we're going to focus on today. We're going to take a little bit of a different style to this presentation. I'm going to moderate this. My name is Eric Wernicke. I'm the president of Wealth Management, and I'll be your moderator this afternoon. And I'm just going to pose some questions to our team here of investment professionals. So with me, I've got Betsy Pearson, who is our Chief Investment Officer, John Colhane, who's a Senior Portfolio Manager with Midland and a Director of Fixed Income, and then Tracy Garst, who is also a Senior Portfolio Manager with Midland Wealth Management. So again, I'm going to kick us off with some questions. I will ask, I think all of you, Chris, who is monitoring our presentation today, has everyone on mute. There will be an opportunity at the end of the presentation to ask some questions. And if you'll notice, I think for those of you familiar with WebEx, there is a box, a Q&A box, where you can actually kind of through a chat process, submit questions that Chris will monitor. And if we have an opportunity at the end of the presentation, we'll certainly take those questions as well. So with that, let's go ahead and get started as we kind of take a look at, where we're at in what happened in 2020 and what the outlook looks like for 2021. And with that, the first question that we hear a lot from our clients and individuals that we talk to is everything that's going on in the world. I already touched on, obviously, the pandemic, number one, out there right now, the most recent election. What does all that mean from a top of the house, big picture standpoint in terms of the outlook for the global economy? And that's where we'll start is what is with everything that's going on today, what does that mean for the global economy?
Okay, I think I'll kick that off, Eric. Thanks for the question. As we all know, 2020 wasn't a normal year, and the recession we had in 2020 was not normal at all either. This chart really exemplifies how this recession was really different than past ones we've had. If you see the extreme downtrend in early 2020 and then the bounce back, where we had 30% negative annualized GDP and then 35% annualized growth in GDP. If you compare that to other recessions that have been much longer and not as dramatically negative in one quarter, they've lasted longer, trudged lower with negative growth over a longer time frame. And this one was really an exogenous event that triggered the global economy to just basically shut down very quickly. And then when it began to reopen, it bounced back almost as quickly. Although 2020 will probably still end up with a negative GDP for the year, estimating approximately, it looks like about a 7% growth annualized in the fourth quarter. You put that all together, we're still negative by 2 to 3% for the year. We did have a pretty severe bounce back. It's been different than most recessions. And with that, we look at it. One of the reasons why it was such a quick bounce was because it was an exogenous event, but also if you look at the next slide, as we entered this recession, consumers as well as corporations were not very highly leveraged. They were in really pretty good financial position and people had jobs. Typically, when you go into a recession, people are more stretched. Corporations are more stretched. The Fed is trying to slow down the economy, raising rates, shutting it down. This was a much different thing where you basically took the entire economy, shut it down while people were still in a really good position. We went into this with a three handle on unemployment. Inflation was low. Interest rates were not exceedingly high, higher than they are today, but not exceedingly high. So it was a really very accommodative position before we even went into this. And then we had, the economy basically shut down. And then what happened was, as we realized how to work from home and to work remotely, and the economy started opening back up in May, late May, 2/3 of the economy started functioning again. And I think that's what leads us into, why we think this year is going to be a better year, is that really 2/3 of the economy is still functioning. Manufacturing, housing, all those things are still functioning. There's still that 1/3 that really is hindered from doing what they want to do. And that's going to remain for a while. Unemployment's still elevated at over 6%, 6.7%, I think the last note was. But compared to other recessions, that's really not that terrible. It's palatable. And the government response, it's trying to help with extended unemployment benefits, as well as continued stimulus. We got another round of stimulus at the end of December going into January. And even as you listen to the restaurants, I think I've read from places like Checkers and TGI Fridays and all that, they said with the round of stimulus that was paid, they've actually seen an increase in people coming in or using the drive-through or whatever it is, or ordering out. And then we have another round as we go into this that, as we open up more, there'll be more of it. In addition, there's another proposal out there where the Democrats are proposing another $1.9 trillion in additional stimulus. That is up for debate. How they get that passed and what actually ends up in the bill is yet to be determined. But there is still a part of our economy that needs additional stimulus, and that would be more from the people who are unemployed because their businesses are not functioning. And until they open up, we're going to need that. We also have this continued accommodative monetary policy globally. And John will go into more detail, I think, as we ask about interest rates, but interest rates are extremely low. Money is easy. It's an easy thing. We have a housing market that is really, really strong. Existing home sales have been through the roof over the last years. You can see from the chart on the left, they were up over 22% year over year. The supply is really low. I think there's about a 2.5 or 3 month supply on the market. And typically it's 6 in a normal environment. People aren't selling their houses, but people are trying to buy. New home sales are strong. All those things. Manufacturing, well, it did have a downturn when we initially shut down the economy for a couple months. It has bounced back. Some of that's built up demand that was out there with backlog, but it's also the continuing need for it. People are still buying products who have the 2/3 that are functioning are still spending money. So when you look at it for the first half of the year, we really do think there will be growth, and probably even stronger growth in the second half as we go forward. And we look at how COVID is impacting it. So if you go to the next screen, COVID still remains a concern, but I think we've passed the peak. So you can see on this chart in early January where we hit the number of the 7-day average, moving average of cases. The number of daily cases being reported is declining across the country. And if you live in Illinois, we've gotten to the point where some of the regions are actually getting to the phase 4 region and opening up, and more things are going to be available. So when you look at that, you have to think, as more people are getting out and opening up, restaurants will continue they'll pick up business. Some of the things, we're not going to see the big venues yet, but you're seeing more activity out there that will help in 2021 to have more growth than we did in 2020. And when you look at and consider the vaccines, which is on the next slide, this is a pretty good guesstimate of when people in the US will be vaccinated and what percentage of the population. And when you look at this, over 50% of the population will be vaccinated by summer and 80% by the fall. And when you get to 80%, to close to 80% vaccination, it's really like, quote unquote, the herd immunity, where the economy can truly open up back to where it was. As long as the vaccines continue to work, the distribution works, this should allow the economy to open up and even lower the unemployment rate, get the larger venues, sporting events, concerts, entertainment, travel, all of those things start to move. And that pent-up demand is out there. Once it is available, it'll be amazing at how it will probably recover fairly quickly. When you sit and talk to people, what they really want to do is they want to get out, they want to go and do. but they aren't able to yet because things are still not available. So I think there's pent-up demand, which could lead to more growth in the second half of the year, even over the first half. So it looks pretty positive for 2020 with everything that's 2021 with everything that's gone on from an economic standpoint. I think Eric's on mute. Eric, you're on mute. Sorry for the confusion.
Could not get through this call without doing that, right? So thank you for that summary, Betsy, on the global economic outlook. Now let's do a little bit of a deeper dive in terms of some of these things around the election. So obviously we've got a new administration in here, a weekend from the inauguration. We heard a lot during the campaign about potential tax changes under the Biden administration, with the Democrats continuing to control the House, and with the vice president vote, the slimmest of margins in the Senate. What potential tax changes could we look at here in 2021 and beyond with the new administration?
Well, tax changes can be put through by reconciliation. And as anybody knows, when you start digging, I did a lot of research on reconciliation and filibusters over the last week, because it really is a big key to what's going on in with this somewhat split government. We're 50-50 with the one deciding vote really being the vice president. Tax changes can go through reconciliation because it's an increase in spending and new revenues to the budget. So with that, we would anticipate that at some point this year, the Congress will put through higher taxes, especially with corporate tax rates going probably from the 21% they were moved to under the Trump administration to 28%. And then they're also putting in a 15% minimum. So corporate tax rates are going to go up. I think they're looking at where the break even is between what they're not going to go back to the level that they were prior to the last Tax Reform Act, but they're going to be higher, but they're going to look at it to see at what point does it become more profitable for a company to do an inversion and change their domicile. And then, at 28%, it seems to be where they're landing, that's where they want them to be. Capital gains and dividends currently are taxed at 20% at the highest. They're proposing that they go to the ordinary income level. Now, for people that are in the 15 or 20% tax bracket, that's not a major issue. But for the high earners who are in that 37 to potentially 39.6% that they want to raise it to, it doubles the amount of tax that you're going to be paying on capital gains and dividends. And it might change the way companies look at how they pay out their dividends if they're going to continue to do it. So there's some different things that will go on, but it does change that method. As I said, they want to increase the top tax rate, and they want to limit some of the deductions. Another thing that's a major thing that we'll have to keep our eyes on, especially for the majority of people who are investors, is they want to apply capital gains taxes to the increased asset values at death. And so when they're sold. So what it basically does is, now we talk about you get a step up in basis when you die. That step up in basis will disappear. Your heirs will then assume that the assets at the lower cost basis, and when they sell them, they will be paying tax on them and not get that step up. So that's a pretty major change that we're going to want to keep our eyes on, especially with planning. All these items can go through reconciliation because they are revenue increases. There'll probably be increased spending along the way. I think, infrastructure spending, they can do that through reconciliation, a number of different things. The one thing they can't do through reconciliation is Social Security changes. So they'll have to be looking at that. And, the big question now out there is, if they want to put something through and it can't go through reconciliation, are they going to try to bust the filibuster, or basically get to the point where it's a simple majority again, rather than the whole process of having to have 60% of the Senate not agree to close debate? And that's been a big change. It's been a big hurdle for many administrations to get through to make major policy changes. So there's a lot up in the air, and it's all in flux, and we can't tell you today what the exact outcome is going to be, but we are monitoring it very closely. There have been a lot of executive orders. We know that Biden's administration is really looking at climate change, immigration, additional spending, and a number of other things. So there may be some things down the road, and as we get those updates, we're going to try to keep everybody in the loop, because it may make an adjustment to outlook for growth, even though tax increases don't necessarily impact growth dramatically, but it may limit it to the extent of the 6 or 7% growth. It might be 5 instead. And will they implement these for 2021 or 2022? That's the other question, because as we've just come out of a pandemic, people are getting back to normal. They may want to increase personal income taxes as well as these. And so do you do that this year, or is it going to take long enough, because they have a lot of things on their plate? You know, they want to get the stimulus through. There's an impeachment trial coming in. And it might be May or June before they even get to these things, which means it may not even be implemented till 2022 or later this year.
Right. Yeah. Thank you for that, Betsy. I mean, we do hear a lot about that, the timing of all this, and this may be a gradual process, not a all at once type of a thing, right? Given the fact that I think the new administration is going to be hesitant to do anything that's going to stall out potential growth in the second half of the year. To your point. So let's move on and kind of switch gears a little bit and talk a little bit about the fixed income market. So Betsy, you talked at the outset a little bit about the potential for growth of the economy, specifically in the second half of the year. And a lot of that has to do, obviously, with businesses reopening and restaurants and things of that nature. But a lot of it has to do with the pent-up demand with the consumer, right? Folks haven't been able to travel as much, take vacations, even go out to eat to restaurants in a lot of instances. We've got stimulus money that's flowing into the economy. So let's talk a little bit about that pent-up demand and what impact that may have on potential inflation increases and interest rates. And so, John, I think, are you gonna handle this one?
Yeah, I'll talk specifically about inflation and interest rates. I love that stuff. I have a chart here showing the year-over-year inflation index, the CPI, Consumer Price Index, and that's the kind of the darker line, and the orangish line is the core rate. The point I want to bring upon us right now is when the COVID struck us back in the end of the first quarter, you can see this tremendous drop in the level of the inflation rate on an annualized basis. We had some months like March that the inflation rate was down 0.4. April, it was down 0.8 all by itself. So you can see on a year-over-year basis there, through the end of May, we had a 0.1% annualized inflation rate. Pretty low, pretty darn low. It has since started to come back up. Yes, definitely what's keeping inflation lower than it should be is that service prices are down. You talked about airline, hotels, restaurants, it's just not much demand there, and so prices have come down because that's the way the market works. However, the price for certain goods, whether it's exercise bicycles for staying at home or whatnot, those items have gone up. But still on a combined basis, we're talking about an inflation rate through the end of December that's running at 1.4%. Now, what's happening, though, is that the market, because of that pent-up demand, that there all of a sudden is going to be some surge in activity, particularly in the service sector, that would push up inflation rate across the board for the nation. And that's important to remember, because I've got that star up there at about 2.5%. That's kind of like a forward-looking benchmark that the Federal Reserve Bank is using. They're not going to be in fact, they're going to continue to be very easy, as Betsy had pointed out, for a period of time until inflation starts getting closer to 2.5 and actually being above about 2.5 for a period of time. Maybe that's 6 months of a period of time. Maybe that's a year. We don't know yet. But we do know that the Federal Reserve Bank is basically going to keep the short end of interest rates going to be low, close to zero for a period of time. So this is going to be one of our canaries in the mine, so to speak, when we start seeing inflation going up. It's not just above 2%, but it's going to have to be around 2.5% before we get something out there. And, granted, we are seeing some inflation in certain pockets. Look at home prices. They're up 9, 10, 11% over year. But however, remember, that came off for a period of time when home prices were pretty stagnant particularly coming out of the last recession. Prices went down, so they're recovering. Energy prices are coming up. You're probably paying a little bit more at the gas station these days, even though you might not be driving around as much, but you'll see prices are going up. So there's starting to be, some worries within the marketplace that some of these inflation numbers will start to go a little bit higher. In fact, here's a chart that looks at how the market feels the inflation rate is going to be in the future. This is based off a 10-year break-even forward pricing. But even then, over a 10-year period, we're looking at prices increasing on average about 2.1%. Very, very limited amount of inflation right now. However, what will make inflation go even higher? Well, it's going to be things like further demand. If we're going to get more stimulus, it's going to create certain bottlenecks. It may create further bottlenecks in the energy market, maybe in the housing market, maybe in the service sector. But when you get these bottlenecks, you do start to create inflation. I talked about capital goods, been strong. Airplane business should be starting to pick up once travel business starts to pick up. There's correlation there. I mentioned oil prices. But unfortunately, what's keeping a lot of prices down is there are some slack portions in the economy. The major slack is people. There's roughly about 8-10 million people who had lost their jobs from the last beginning of the COVID that have not returned back to work. Granted, about 10 million did go back to work, but there's still about 10 million that haven't. And as Betsy pointed out, that's in the travel, the leisure, the restaurant, the pubs, whatnot. Those folks particularly have not gone to work. And frankly, a lot of those businesses have been closed and may not reopen. But given the strength of the economy and the easy money, we should start seeing probably in the course of the next couple of years, those folks going back to work, particularly if the COVID virus, the vaccine works. And we should start seeing that back in about 2020. We won't get an unemployment rate as low as we had. Remember that we're probably running at about 6.7% right now. The lowest it was the earlier part of last year was about 3.5%. It's going to take some time to do it. But remember that, there's things here besides inflation that affects interest rates. But inflation is one of the major concerns. You can see here, this chart looks at how interest rates were about 6 months ago, back at the end of July. You can see the curve that's looking at the maturities at the bottom, going from the shortest from the left to the right, and interest rates going from the lowest to the highest on the far left-hand side. And you can see what happened to interest rates. The very short end of the curve, the 1 month, the 6 month, even up to 2 years, there's been no change out there in interest rates. That's because the Federal Reserve Bank has effectively anchored the easy monetary policy and low interest rates until they start to see some, as I mentioned before, some inflation. However, you're starting to see a little bit of a divergence in that interest rates in the course from 6 months ago till just this past week. And there's several reasons for that. Number one, there's new supply. There's already about over $2 trillion of stimulus that came out last year. And there were worries about another, not worries, but talk about another $1.9 trillion in the new spending bill. That still doesn't quite, it's not going to happen right away, but it's going to probably something close to it's going to happen in the next couple of months. And so when you worry about interest rates and what the direction they should be going, besides looking at inflation, which is always adds to the longer term interest rates more than the shorter term interest rates, you have to look at supply. And we are going to get some more supply, and that's why one of the reasons why the interest rates go up, because the market doesn't really wait for changes in interest rates or changes in inflation. It more or less anticipates it, and that's why we've had that pretty much run up. As far as the Fed, it's kind of interesting. Today, the Fed is meeting one of their periodical FOMC meetings. I wish I'm kind of delaying here a little bit to see if there's any kind of new news that might pop out here, so you can hear it right away. But what we do expect is that the Fed does want full employment. They want low inflation. They're not going to act on particularly the raising short-term interest rates. They're going to stay accommodative for a long period of time. Long period, I know is relative, but you got to figure this year into next year is a good indication of them keeping interest rates low. However, one of the things they're also doing to keep interest rates low is they're buying about $120 billion. Got to keep my B's and T's difference here, but they're buying $120 billion of securities every month, and as such, that's keeping interest rates low too, particularly on the longer end of the curve. It doesn't mean the Fed can control it forever, because the market is a much more powerful base than the Fed itself. The Fed allows for a benchmark here. So I've kind of mentioned a few points here, particularly that as you go forward, this new stimulus is going to have some problems for bringing in new supply. And remember, when you have new stimulus, it will create demand, which means more or less there's more demand than there's supply, which creates inflation. And as such, we're kind of worried, not right away the interest rates are going up, but we can see that the longer term interest rates could go up if there is more inflation that comes down the pike. But if you look at the kind of the numbers very closely, you'll see that as I mentioned, we had some negative numbers on a monthly basis in early 2020. Those numbers kind of roll off and we start getting current numbers. So it may look like we may get a small spike in the CPI inflation numbers that'll be coming in the next couple of months. But I think once we get past that, you'll start seeing more of a stabilized inflation, probably close to 2%, but still not at that level that would trigger anything that the Fed would start to raise lower-term interest rates. What the market is really kind of in the back of their mind thinking about is how long the Fed will continue to purchase that $120 billion worth of securities every month. The last time when they were doing this back in the 2012, 2013, in 2013, remember, the market always tries to anticipate. It doesn't wait, it anticipates. Back in 2013, they mentioned they were thinking about tapering interest rates, which means they were going to reduce the amount of purchases over a period of time. The markets, the 10-year at that time, rose over 110 basis points in a very short period of time because they were worried the Fed was going to leave the market. So the Fed has this very important job of continuing to buy, and then they have to convince the markets that there's enough demand out there once they leave the buying to the Treasury. So that's an important thing to kind of look forward to. And as such, as long as we have interest rates low, that means product spreads kind of remain tight. And, people need to buy, investors need to buy bonds, and as such, there's a great demand for securities out there, and it's push interest rates down, or the credit spreads lower. And they're at lowest levels they've been in the last couple of years. I got a slide here. I was talking about the Fed funds rate. The middle part of this curve looks at the implied Fed funds rate at the next several Fed meetings. And I've got it all the way out to 2022, the beginning of it. And behind it, you can see the track of the Fed funds rate, the very short-term rates over the last couple of years, and how on the lower right-hand side, we're basically stuck at zero for a period of time. But even looking out 2 years, a year forward, we're looking at 6.8 basis points. So what the market is suggesting is that the Fed is not going to do anything for the next year, and I don't think we're not expecting anything going to be happening from them until maybe late 2022 if they're going to be moving the short-term interest rates. But it's also in 2022 we expect them to be talking about reducing the amount of buying they could be buying, of the amount of securities they've been buying. And this particular chart looks at the amount of purchases or the amount of holdings that the Fed continues to have on their balance sheet. That tremendous jump up there in March was the first first stimulus program, followed by their buying of a lot of those securities, and then continued buying here, 120 billion a month. You can almost see a projection going forward. This is easily going to be about $8 trillion worth of holdings, probably by the end of this year. And it's why the market is very concerned that if the Fed starts reducing their balance sheet by tapering their purchases, that we'll probably see at that point in time whenever that might be, when longer-term interest rates really start to decline. But right now, the short end is pretty much anchored. Long end's going to have some flexibility, but not to a point where, we're seeing 2% kind of levels on the 10-year.
Excellent. Thank you for that, John. And as John mentioned, we're constantly monitoring the situation, including the meeting today. And if we have any updates on this call that come through, we'll be sure to get those to you. So let's change gears again, and let's in any time frame, we're always asked about what's going on in the equity markets, right? What's going on in the stock market? It's a common question, and certainly given the conditions that we've talked about with the pandemic and the election and potential tax changes, it more so than ever we receive that question. So, you'd be hard pressed to find anything positive to talk about 2020. But one thing that was positive was the stock market, with the S&P up, I think, over 18% over the course of 2020, despite what Betsy talked about, the sharp decline in February and March. So with that, I'm gonna kind of turn it over to Tracy Garris, because again, the question we get is, what's going on? What does all this mean for the equity markets, and what's Midland's position on that? So Tracy?
Yeah. Thanks, Eric. Eric, I think that's a perfect lead-in to this whole conversation is, after everything that happened last year, what really came from the significant downturn was exactly what John said. We have a very dovish Fed, and there's an old saying, don't fight the Fed, and that's really where it's at right now. With the amount of liquidity and fiscal stimulus being pumped into the economy and a very, very dovish Fed, it was very supportive for the market last year. The market rebounded very strongly, and we do think that will help support stock prices this year as well, in addition to additional stimulus. But I know from my meetings, the number one topic entering 2021 is this market overvalued? And I like to start with a simple fundamental chart of current PE ratios. And we look at the next 12 months, the forward PE ratio of the S&P 500. Currently it's anticipated about 22 times. On a price to earnings basis. And the most important thing here is going to be the E in the price to earnings ratio. What is that earnings going to be? And there's a lot of optimism right now that we're going to see significantly strong earnings and earnings improve as we move into not only a reopening of the U.S. economy, but also a global reopening. And you can kind of think of it as a synchronized global recovery as we get through the winter months this year and get into the spring and summer. So we're pretty optimistic that we will see a pretty strong rebound in earnings as we move forward. Valuations at 22 times. I think the first thing we have to realize is market valuations are a terrible timing tool. You really can't rely strictly on what the current PE ratio is. Those are going to change based on fiscal policy, monetary policy. They're going to change on what type of policies we're going to see come through from Congress. Betsy made a great point when she talked about capital gain or corporate income tax. That would have a major impact on these earnings numbers going forward. But the big question I'm getting right now about the current chart that you're looking at is this the beginning of another technology bubble, 99, 2000? And our opinion is no, it is not. Technology companies today have very strong earnings. They have very strong revenue. It's totally different than what we saw in the tech bubble. In 1999, U.S. Treasury notes, John knows better than me, 10-year Treasury is trading close to 7%. Today it's at 1%. So you can actually argue that bonds might be more overvalued than stocks when we look at earnings yield. And money markets are basically making next to nothing. So there's not a lot of other alternatives Stock dividends are higher than a 10-year Treasury yield. Those things will continue to probably support stocks. Also, 1999, the Fed was raising interest rates. That's not happening right now, and we don't anticipate that happening at this point. And then the last thing I would suggest looking at this chart, if you look at 99 and 2000, 98, 99, and 2000, that was the end of the cycle. That is when earnings really started to decelerate and turn lower. We have gone through a recession. We have gone through the big earnings deceleration. We're now getting back to a cyclical recovery, we believe, this year and particularly this summer, and earnings will actually accelerate. So kind of a different scenario today than what we saw back in 99 and 2000. With interest rates this low, PE multiples can trade higher than what we might normally expect. So we do think the market is pretty fully valued right here, but we do expect earnings to accelerate as the year progresses. And as we move to the next chart, I'm going to kind of talk a little about the good and the bad. So kind of the bad, valuations a little high. I like to watch what we call the Buffett indicator. Warren Buffett looks at a ratio that's basically, he takes the stock market capitalization, the market value of the U.S. stock market, large, mid, small, the whole stock market, divided by the percentage of nominal gross income. Some people do it by GDP. But if you look at this chart, you can see we're at an all-time high. And this is one reason that he kind of got criticized in March and April last year. He really was not a big buyer of the market. And you can see at the top chart, that blue line is a trend line and how far above trend we've gotten. It's okay to move higher because that is the trend, but how high do you get above trend line? And the difference, I would say, if we go back to the global financial crisis in 98, 99, or I'm sorry, 2008 and 9, the market corrected so far, and you can see at the top chart, the gold line, how far that went down to about 60 below that trend line. And he was a very aggressive buyer in stocks in 2008 and 9, Warren Buffett was. And you can see at the bottom, the blue line, it actually hit the undervalued area of the market. This last year is a little different in that based on this simple ratio, the market never really did get fully undervalued. It got more reasonably valued, but not totally undervalued. So this is something to look at. And as we said, if earnings improve, we get people back to work, and when GDP improves, gross domestic income improves, this type of a ratio will become more attractive. But it is a little concern that maybe this market is a little bit ahead of itself right now. And as we flip to the next chart, and every day we come in, it seems like we see another instance of, are we seeing bubbles in this market? As I said, we don't think technology is in a bubble. Some technology stocks might be. Some of the stay-at-home stocks might be. When you get a Zoom that's done really well but is trading at ridiculously high PE multiples, maybe it is overvalued. But there are areas of speculation and concern. I think Bitcoin is an area of concern. Is it getting in that speculative area? Possibly. The stay-at-home stocks, some of these tech stocks that really went crazy last year. A new one, the SPACs, the special purpose acquisition companies. I won't go into detail, but they're becoming a big player in basically buying companies before they become public. Margin debt is very, very high in this current market. Part of that is because interest rates are so low, money's very cheap. But that is something that is a good indicator sometimes of excessive speculation. And I think something as simple as Tesla can be, yes, I was wrong on Tesla all last year. like a lot of people were. But I think you look at Tesla and begin to wonder if there's an awful lot of speculation here. It currently trades at about 217 times a forward PE ratio, a little overvalued by that measure. And the other thing, look at this chart, is kind of interesting. Tesla's market cap at the time that I pulled this chart was 615 billion. It's now approaching closer to 700 billion. Look at all of the other automakers. They are less as a total in market cap than Tesla. But look at the revenue. These other automakers account for about 1.1 trillion in revenue a year, as opposed to Tesla at 33 trillion. So is that kind of valuation justified? I think we're going to see, over time, we're going to see speculation in the market. I think the speculation will gradually disappear. I won't get into it, but one of the big speculations today is GameStop. It's basically a short position that's created a lot of news in the market. So there are definitely some areas of speculation, but as a whole, we don't see the market as totally irrational. Not like, and the last thing I would say before we move to the next chart is the stock market can stay irrational for a while. Alan Greenspan said this in 1996, that the S&P 500 was, we were seeing irrational exuberance. That went on for 4 more years and 4 consecutive years of 20% plus returns in the S&P 500. So it can continue like this for a while. And I'll flip to have the next page, and a couple things that are positive, we think, on the front going forward. Number one is what we call the output gap. The S&P 500 has seen very nice returns in the stock market when we've had a negative output gap. And basically what that means is it's the difference between what the economy is actually doing, such as GDP growth, compared to what it was doing before COVID. And you can see how this output gap went down to -10. So basically, the economy was operating way below potential. We anticipate it will get back to trend, which is probably somewhere around that 2% range. But while it is in a negative output gap, stocks could do very well and historically have done very well in this period of time. So there is significant room for improvement. And this could take a number of years to get that back to positive and back to trend. So that is a positive we see going forward. And as we go to the next chart here, interesting with this recovery, this kind of relates to the output gap. If you look at the dark blue bars, this was the decline in GDP growth for a number of different countries during the 2007 to 2009 global financial crisis. COVID pandemic has been significantly worse. So we would actually expect the market recovery, both the economic recovery and the stock market recovery, to be greater on the upside than what we even saw from that global financial crisis. And as I said about the output gap, to close that gap is going to take a number of years, and we would expect that to be the case here at GDP. It's going to take several years to get back to pre-COVID levels. So there is room, again, for improvement, both in the economy and the market as we move forward. Now, the next chart, and probably the most positive thing we're seeing in the stock market, both in the U.S. market and globally, is what we call the breadth of the market. And this chart, if you look at the bottom chart, really is what I'm focused on. The percentage of markets that are individual stock markets in the U.S. and abroad that are now above their 200-day moving averages, and we were near 100%. If we think about last year, and I'll actually have a chart later, but last year we had a very concentrated market up until November. Stocks were basically concentrated in technology stocks, stay-at-home stocks, the big winners of Amazon and Walmart and Costco and those type of names. Since November, and we don't believe it had really much to do with the election, when the vaccines rolled out. Both Pfizer and Moderna had very, very good results, and since then the market has taken off. But what has taken off is a broadening of this market. Small cap stocks, cyclical value stocks, international emerging markets, all the areas that lagged last year have outperformed since November and since the vaccine has rolled out. We expect that to continue as we move forward throughout 2021. But the breadth of the market is very, very important. So this is a really good sign that this breadth is actually improving. And with that breadth, on the next chart, we have made a number of changes to our portfolios at the end of last year and early this year. And the biggest change is getting more cyclical, moving into heavier exposure to small cap stocks and the cyclical value stocks. And you'll see at the bottom, the green line are basically our cyclical value stocks such as financials, industrials, basic materials, commodities, and even energy. We expect these to begin to perform better, such as they have since November, and they could be the biggest benefactors and will be the biggest benefactors of a reopening of the U.S. economy. I think what is very interesting with this chart is that those cyclical value sectors have fallen and have come down to about 24% of the entire S&P 500 index, and the remaining 76% is in growth and what we call stable and defensive areas like consumer staples and healthcare and discretionaries. We think you're going to see some reversion to the mean. Some of the underperformance from value, cyclical value, they will probably make up some ground, and maybe some of the more growthy names might give up a little bit. But we actually think all of these sectors, technology, healthcare, as well as financials, industrials, will do very, very well through this reopening. So that we're still a little bit overweight growth, but we did increase our cyclical value exposure earlier this year. And of course, one of the main reasons we did it, as I said, was last year was really a year that we saw a very concentrated stock market, a broadening out of 2021. Not only will it be good, it will be crucial for the overall market to do better. If you look at this chart, the top 10 stocks of the S&P 500, and we know who they are: Apple, Microsoft, Google, Alphabet, Facebook, heavily technology oriented, made up roughly 28% of the S&P 500 as of December 31st. And if you look at earnings, those 10 companies accounted for almost 24% of all earnings of the S&P 500. We think the earnings growth this year is not, those companies will grow, but the significant earnings growth probably won't come from those 10 stocks. It'll come from those other areas that have lagged that will see significant earnings growth as the global economy and the U.S. economy open up. So good reason to diversify out. And I think this year, diversification is going to be a key. That's why we increased value, we increased small cap and mid cap. We increased our international emerging markets exposure. So other catalysts with the next chart that could potentially help the market this year, we know the Fed, we know fiscal stimulus, but share buybacks. As you would expect with last year, companies were not buying their shares back. You look at this chart, that blue line are share buybacks, and they've actually been declining since July 15th, and companies have bought fewer shares back. We think companies will step up, begin to buy these shares back. Procter & Gamble already announced a very significant buyback, and we expect more companies to follow. So that would be one catalyst. And then the last chart I have, and again, going with our tactical adjustments this year, as I said, we've increased our international exposure a little bit, and particularly emerging markets. A weak dollar, as the dollar has weakened, we think it will continue to stay weak with the amount of debt that we're going to be bringing on. We look for a weak dollar. That should help emerging markets outperform and ultimately help international. And if you look at this chart, we showed this before, international has significantly underperformed the U.S. market. If you look from 97 to about 2011, 2012, international and U.S. markets tend to go hand in hand. They were pretty closely correlated. But at the middle and end of 2012, 2013, the correlation ended, and we saw significant dispersion in returns between U.S. market and international. Thereby, it has really made international markets awfully attractive looking at valuations. The weak dollar leads us to believe we want to have a little bit of an overweight to this area. And if you look at the kind of the red arrow I put in here, the amount of dispersion and the amount of outperformance from the U.S. market, we do think that will probably start to shrink a little bit this year. So that is another one of our tactical moves we have implemented this year. And with that, I'll turn it back over to Eric.
Thank you, Tracy. Great information there. And as Tracy touched on a few different times, obviously this team here, our panelists, as well as our overall entire portfolio management team, is constantly monitoring the circumstances, what's going on in the economy and the markets, and making those tactical changes that Tracy spoke about that we did here at the end of 2020 and into the first part of 2021. So pretty optimistic outlook from our panelists here this afternoon. We talked about the potential for economic recovery in terms of the U.S. economy here moving into the second half of the year and GDP growth, low interest rate environment. Tracy just talked about the fact that earnings, looking for earnings growth here in 2021 that could continue to support a positive stock market. But there's got to be some risks out there, right? So let's talk about those. What are potential, what are potential headwinds in terms of this optimistic outlook for 2021?
So I think from a growth standpoint, the vaccine distribution is a major driver of how fast the 1/3 of the economy recovers. And we all know there's been some logistical as well as manufacturing issues with getting that distributed and how many are going to be out there. So we're going to continue to monitor that. And if we don't get to that 50 to 70% vaccination level by midsummer to late, early fall, you have to think that the economy will not grow as quickly as maybe we anticipated. It may trudge along, but it may be a risk. I think as John said, if there's excessive stimulus, it leads to higher inflation. And how much debt is going to be issued, who's going to suck it up, how much are taxes going to go up to cover it, are we going to be able to afford it, are we going to have that higher inflation, and will it drive the Fed to have to tighten and globally, and the global banks, central banks, make that move. And as Tracy said, the earnings are really what's going to drive the market this year, on top of, there's really not any place else to go with your money. But otherwise than that, you have to have earnings. And if earnings do disappoint, it could mean a pullback in the market. They're expecting good earnings. We're expecting good earnings. But if it doesn't happen, what will be the impact to the markets and to the economy? And then geopolitical, we always have geopolitical issues. We have political issues alone in Washington, let alone geopolitical across the globe with, North Korea, China, Iran, all the different parts of the world. And you look at it and go, we have a new administration, and some of those leaders are going to try to challenge it because it's somebody new. They had Trump for 4 years, good or bad, not going on that end, but they have someone new. So what's that stance going to be with that, and what impact will that have globally? And I think that's a question, and I think John and Tracy, if you have more to add here, please jump in.
Betsy, I would add one. I'm going to go to the earnings situation. I would add this: we're right in the heart of fourth quarter earnings. Generally, they've been pretty good, but if you look at the earnings pre-announcements prior to the earnings being announced here, we had a very, very low number of companies pre-announced negatively. We actually had a very large amount of companies pre-announced positively. So that's actually a good sign, at least based on the fourth quarter earnings that we're seeing now.
Right.
And you brought up the excess stimulus creating higher inflation. And one of the caveats of interest rates is the higher the inflation, the higher interest rates should go. So it's important to see, yes, we'll probably have an increase in inflation, but as long as it's kind of a contained level, 2%, I don't think not much is going to happen until the Fed starts to kind of reduce their purchases. Then when you've got that tapering plus the higher inflation, then you got the long end of the tail of the yield curve going higher. And then the higher interest rates will have an effect on the stock market, definitely.
Mm-hmm. Yeah.
And Betsy,
I know we're coming.
Yep. Go ahead, Eric.
Well, I was just going to say, I know we're coming up to our time here, and want to be sensitive to everyone's schedule here this afternoon, and thank everyone for participating in the call. It does look like we have one question come in through the queue, and so I wanted to touch on that. The question basically is in regards to budget deficits. So you're starting to hear a lot about that again. With what the Fed is doing that John talked about, certainly, if we're talking about more stimulus, whether that be 1.9 trillion or wherever that dollar amount lands, that's going to contribute to the deficit. So maybe I'll toss that out to the group. Maybe John, you can touch on that as well. But how concerned should we be about increasing budget deficits?
Well, unfortunately, the line would be, it's not a concern until it's a concern. It's not a problem until it's a problem. And right now, the focus is getting the economy up and going, no matter what the costs. Somewhere down the line, maybe not this Congress, maybe the next one, the next presidential election, the budget deficit will once again be a front and center type of theme for the candidates to kind of debate. Personally, we can't have all these deficits. We can't spend a lot. But at the same time, we've got a chance to earn out of this. The economy gets better. It probably help. So I think it's kind of a longer term problem right now rather than a short term.
And John, wouldn't you agree that the cost of debt right now is not very much? So the interest cost has limited it. So while the deficit, and this is once again can be a short term thing, but as interest rates go up, it becomes a bigger concern as we have to finance that debt.
You're absolutely correct. I mean, right now it's cheap money. You see how that on that yield curve, you can borrow money out to 10 years easily and under 110. Short-term interest rates, the T-bills are basically paying nothing. So the government's getting a kind of a pass, a hall pass at the moment, in order not to be able to pay the costs of those deficits. But when interest rates start to climb, maybe twice these levels, all of a sudden those costs of interest is going to become a greater portion actually of the annual budget. Then you'll have people screaming.
And then you'll see more tax increases or something else cut if they contain the deficit.
Unless we can get the economy to grow at probably twice normal, the last 10-year averages.
Which is hard to believe it will happen once we get to a level and get back in the norm.
Excellent. Thank you for that, John and Betsy. And I don't see any other, Chris, correct me if I'm wrong, but I don't see any other questions in the queue, and I've got it here right just after 1 o'clock. So again, thank you to our panelists, and thank you to all of those who have dialed in and participated in this call this afternoon. As I mentioned at the outset, and wish everyone to stay safe and stay healthy as we hopefully round the corner here on this pandemic and get closer to all of us being vaccinated moving forward. Again, we'll look to do this event maybe sometime mid-year. Certainly, if circumstances warrant, based upon economic or the news of the day, we will pull this group together again. Please follow us on if you want access to any of this information, and including our monthly updates and our quarterly newsletter, the Midland SB, www.midlandsb.com. Under the Wealth tab, we compile all of this information, and you can access that. And obviously follow us on LinkedIn as well, Midland Wealth Management, where we periodically post this information as well as more frequent updates. So thank you, everyone, for taking your time this afternoon. I'll look forward to speaking to you in the future.